Hello financial fans, welcome back to another stock analysis. Today we'll be covering LVMH stock ticker MC on Euronext Paris. LVMH is a French multinational corporation that specializes in luxury goods. LVMH is the world's largest luxury good company and is headquartered in Paris, France. The company operates more than 60 subsidiaries that produce products such as leather goods, fashion and clothing, perfumes and cosmetics, watches and jewelry, and wines and spirits. Some of the most well-known brands owned by LVMH include Louis Vuitton, Dior, Fendi, Bulgari, Moët and Chandon, Hennessy, and Marc Jacobs, among others. LVMH is committed to preserving and promoting the traditional techniques and cultural heritage of the luxury goods industry and is recognized as a leader in the field of high-end design and craftsmanship. They're currently sitting at a 405.4 billion euro market cap, and in 2022 they generated a revenue of 79.2 billion euros. Their dividend yield is currently sitting at 1.48%. 9% of their revenue comes from wines and spirits, 49% from fashion and leather goods, 10% from perfumes and cosmetics, 13% from watches and jewelry, and the remaining 19% from selective retailing. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health and the growth of the company. We'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety will increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from our margin of safety. The first two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has grown going from 6 billion euros in 2013 to 21 billion euros in 2022. The average growth in EBIT during this period was a very massive 19%, meaning a 5% deduction from a margin of safety. The margin has also increased, going from 20.75% to 26.5% in 2022. The average growth in margin was a very nice 3.8%, meaning a 5% decrease from a margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up, going from €2.20 in 2011 to 12 euros annually per share in 2022. The average growth in dividends was a very nice 18%, meaning a 10% deduction from a margin of safety. This, while the payout ratio is still sitting at 43%, which in this case means no change in the margin of safety. Still lots of room left for LVMH to increase their dividends. The final two metrics that we're going to use are the debt to EBITDA and the return on invested capital ratios. Debt to EBITDA. To get our debt to EBITDA, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For LVMH, this is just over 1 year, in this case a 104% debt to EBITDA ratio, meaning a 5% deduction from a margin of safety. The return on invested capital ratio is sitting at 13.6%, meaning another 5% deduction from a margin of safety, so it's looking very good so far for LVMH. Let's go look at the valuation models next to determine the intrinsic value of LVMH. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow during this period was just under 19% annually, and I'm projecting a 6% growth rate over the next 10 years per year. With this percentage, we can determine the future free cash flow of LVMH and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of 292.1 billion euros, and to get our equity value we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of 267.8 billion euros. All that's left to do to get our discounted cash flow price per share is divided by the amount of shares outstanding, leaving us with the discounted cash flow price per share of 534.64 euros. With the current price of 829.40 euros, we get a downside of 294.76 euros, which is a 35.5% downside. The second model that we'll be using is the dividend discount model. In this model, I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends during this period was just under 25%, and I'm projecting an expected growth rate in dividends of 5% over the coming years. And we'll also once again be using a discount rate of 8.5% in this valuation. And this leaves us with a dividend discount model price per share of 720 euros. And with the current price of once again 829 euros and 40 cents, out of this model we get a downside of 109 euros and 40 cents, which is just over a 13% downside. Third valuation model we'll be using is the Graham's revised valuation formula, which is going to be a new entry into our stock analysis videos. This valuation will be looking at the earnings per share of the company. This will be compared to a PE of a company with no growth. We'll be projecting a growth rate estimate for the company. And we'll be looking at the current yield of AAA corporate bonds, which in this case is 4.3%. We expected a growth rate estimate of 12.5% as per analyst, what Wall Street is pretty much expecting. And the earnings per share of LVMH, which is currently $28 or 28 euros rather, and 3 cents per share. This leaves us with a fair value out of Graham's revised valuation formula of 559 euros and 30 cents, and with the current price of 829 euros and 40 cents, we get a downside of 270 euros and 10 cents out of this model, which is a 32.5% downside. The fourth model that we'll be using is the multiple valuation. In this model, we'll be looking at similar companies to LVMH, look at their stock price and the earnings per share, so we can determine a PE multiple, an average PE multiple, rather, in the industry, which in this case is 31.89. This will then be multiplied by the earnings per share that LVMH is generating, which is the same 28 euros and 3 cents as we used in the last valuation formula, which leaves us with a fair value of 893 euros and 84 cents, which is an upside of 64 euros and 44 cents, which is a 7.77% upside. The last valuation model that we'll be using is the mean reversion theory, which also once again will be a new entry to the stock analysis videos on this channel. In this model, we go by the idea that a company will trade above its mean or trade under its mean price. So it will always be a mean reversion either to the upside or the downside. And this will be done by looking at the dividend yield and the PE ratio, which in this case we have imported the dividend yield going from 2018 to 2022. The average yield during this period was 1.42%, and the current yield is 1.48 or 1.42%. Yeah, the current yield is 1.48%, meaning it's undervalued by just a tiny margin. We'll also be looking at the PE ratio and looking what the average PE multiple was in the last 5 years. So I've imported the PE ratio going from 2018 to 2022. And the average PE multiple during this period was 32.16, and it's currently trading at 29.59, meaning it's once again is undervalued. Doing the calculations on this, we get a fair value of 883 euros and 52 cents. And with the current price of 829 euros and 40 cents, we get an upside out of this model of 54 euros and 12 cents, which is a 6.5% upside. Let's go look at the final overview of our valuation models next. Looking at our final overview, it looks slightly different than what we usually use, since we have two new additions to our valuation formula, which is Graham's valuation and the mean reversion valuation. So we have imported the discounted cash flow, the discounted dividend, the Graham's valuation, multiple valuation, and mean reversion valuation prices per share, leaving us with an average of 718 euros and 26 cents. Margin of safety we have calculated earlier using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, another 5% for the EBIT growth, another 5% for the margin growth, another 5% for return on invested capital, and another 10% deduction for the dividend growth, leaving us with what usually would be a minus 5% margin of safety. But the margin of safety, as we have spoken about earlier, can never be below 0%. This makes it that the fair value is exactly the same out of the averages of the models, which is still the 718 euros and 26 cents. And with the current price of 829 euros and 40 cents, we get a downside out of all of the models, our whole valuation formula of 13.4%. So in this case, it would be a sell, which kind of makes sense since it's trading at all-time high prices currently. So I would wait for a pullback to enter it. But I really like the stock, I really like everything behind it, it's just way too overvalued at the moment. If there's any other dividend companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.